Hello, and welcome to Adam's Swing Trading Masterclass, Unit 1, Introduction and Basic Philosophy. Quick disclaimer before we start, any views or opinions in this course are strictly my own. I'm not a financial advisor and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals to theirs using different data. Right, so we'll just go quickly through the learning objectives here in Unit 1. Course overview, swing trading, my technique, and analysis styles. So we're just going to go over the general roadmap of this unit here, the context and goals of swing trading as I see them, my method, my technique, and the and analysis. We're going to be trying to find the signal in the noise as far as figuring out what the future holds for us. Course overview. So these are the units that I've planned out for us. We're here at number 1, Introduction and Basic Philosophy. Number 2, we're going to be looking over asset selection and why, what we have to choose from as far as swing trading. We're going to look at how Bitcoin relates to alts and what signals we can get out of those. The purpose of Bitcoin, the purpose of alts. Unit number 3, we're going to be going through why, in particular, I choose ETH. Number 4, long-term core. We're going to be looking at the stock to flow model and why I believe that's critical to our swing trading process. Number 5, long-term complements. So these are additional analyses that goes on top of the long-term core stock to flow model, how we're all going to be predicting the future. Unit number 6, the enhancements to our long-term, so the medium-term optimization. Number 7, conviction as a function, so how we size our positions and how we know how confident we can be in the future. Unit 8, entry and exit timing, self-explanatory. Unit 9, maximizing capture. This is going to be to essentially find out where to take profits while we're within trades before we close them to take maximum advantages of any randomness in the price. And number 10, summary and final trading plan. We're going to be basically going through that and just summarizing everything that we've looked at so far and bringing everything down to the absolute most practical terms that we possibly can get to. In that one, we'll be helping you design your final trading plan, something that will be hopefully very appropriate to your personality and your trading style and what your goals and things and everything are. I imagine your goals will be similar to mine if you're taking this course. And essentially getting you to the point where you can get the absolute maximum results with the minimum amount of effort, which is my holy grail. And I'll certainly be doing my best to get you guys to the same spot. Right, so the way I'm going to be teaching this, you're going to be feeling a little bit of information overload. The objective of this course will be to push you through the no man's land of information overload as fast and as efficiently as possible. If I don't take you through the full learning curve, you will likely not understand the structure of the final trading plan. So you're going to be starting somewhere over here where you don't know very much, and I'm going to be taking you through the entire learning curve to the point where you're going to have so much information thrown at you that you're not quite sure what you're going to be able to use. But as you go from simplicity, uninformed simplicity, to complexity, I will be pulling you out the other side and taking you to informed simplicity. So by the time you get lost in this ocean of information here, I'm going to be dragging you out the other side to getting you to a point where you only have the information that works for you. If I don't take you through this process, you will not know if you're here or here. You won't know where you are. You won't have any bearing on where you are in your learning process. So believe me, I've thought of different ways of approaching this. I believe this to be the most effective way, so you can look backwards and see all the useless trash that you've left behind, and so you can move forwards with your life and only keep the stuff that works. Quick note on Google. If I use a word you don't understand, Google it. If that doesn't help, then ask me. I imagine I'm going to be using a lot of different words you've never heard before in maybe unusual contexts. That's okay. have a Google look for it. If things still don't make any sense, then by all means, please hit me up and ask me to clarify stuff for you. How this fits in. The Swing Trading Masterclass also requires basic knowledge from these different channels. To start here, first $100, crypto resources, crypto strategy, and the professor's notes. And stock resources if you want extra credit. These, I put videos in here on trading psychology, extra ones on how to live a successful life and why trading sometimes doesn't work for all people. Very, very interesting. But everything is also very critical, foundational knowledge. So please make sure you watch and read through all these different channels. Right. So the swing trading method itself. The problem with buy and hold investing is that it doesn't optimize to limit losses or increase performance in general. Additionally, short-term trading requires too much time input and the emotional burden of execution is quite high. My philosophy is that I wish to form a process where there's an optimal balance between time deployed versus maximizing results. The strategy requirements is that it must reduce drawdowns, so we're trying to reduce risk here, but while maintaining exposure to large bull market moves and must exploit opportunities for profit. Quick side note here, I do talk a lot about risk management in my trading and investing approach. However, it doesn't mean that I'm delusional. I do want to maximize profits. I do want to maximize my opportunities. So you can rest assured that when it comes time to make big money, I'm all about it. I wouldn't have made as much money as I have if I didn't. So the trading technique. This is essentially the fundamentals of what my investing swing trading technique looks like. First, we have the price here that looks like a bit of a sine wave. This is conceptual only. Price never moves like this. However, what we look to do is if we're trading up and we're taking profit, we look to then short and then reverse the direction that we're betting on the market so that we make money as the market declines. If you've never shorted the market before or you're unsure what shorting is, please look that up. It's essentially betting on the decline of the market, so you're making money when it goes down instead of making money when it goes up. You're going to be making money as the market declines, and then as we get to a point where we're not quite sure if it's about to reverse, but we've made a lot of money, we're going to be using some analysis to take profit and incrementally reduce our position. This is to increase the capture that we can get from the entire move, because as you see, if we didn't do this, then we would be losing some of the capture of the profits from this bottom one quarter of the move here. And then after we've taken some incremental profits, after we have enough information to confirm that the trend has reversed convincingly, then we take all the remaining profits in the position and then flip long. Then we make money when it goes up, and it goes up, 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 up. We're making money this whole way. We're making money all the way down, all the way back up again, until we get to a position where we're believing that it's looking a little bit too overbought, looking a little bit too overheated. We're not quite sure if it's going to keep going up or whether it's going to reverse. That's part of the game. So we're going to take some profit by incrementally reducing the position. And then after the market has turned convincingly enough and we have enough information to confirm this turnaround, then we take all our remaining profits and flip short. This process, in theory, repeats to infinity, and you can see that what we're trying to do is capture all of the move at all times forever. So we're constantly exposed to some form of profit-making opportunity as the market goes up and down. So what I want you to do is have a look at this chart here of Bitcoin and ask yourself, where would you draw the lines if it was your responsibility to try and maximize the capture within a swing trading context? Would you be trying to grab every little squiggle? Would you be trying to grab the entire sweeping move all the way from down here to all the way up here? Or would you try and segment it in little tiny bits? Would you go short there? Would you go short there and long there? I won't keep you in suspense. This is how I view the market. you at some point you have to draw a line somewhere. There has to be somewhere where you say, okay, that's quite enough. For example, this bit here, you could go short and then long again. No, I want to try and simplify it as much as possible. And remember, we're trying to minimize time input while also maximizing capture, while also reducing drawdowns and optimizing for profit-making opportunities. That looks something like this when we apply extra analysis and we can figure out that we're in a position where the market is extremely oversold, that we have exceptionally good value. I might even open leveraged positions. That's the double line here, where we're taking leverage and applying it to a deeply oversold condition and making double our money on the way up, instead of just taking on, average probability positions. In addition to this, we're looking to identify locations where the price is both very cheap and very expensive so that we can incrementally take our positions off and maximize capture before the trend reversal is confirmed. This is a diagram just to show you the average duration of trades that I typically like to take. Clearly, this one continues up on. We all know what happens after that, but generally, you can see here we're in the hundreds of days. We're in the several months to a month, maybe even a couple of weeks. But generally, very long positions, as long as we can, while maintaining good exposure to the market. And as far as magnitude of moves, we're looking at several 100% for the large ones. These are the ones that we're going to be trying to get extra exposure to, perhaps even leverage, and large declines as well, where we can reverse this and make money out of these, declines. And typical crypto market fashion, when you're reversing these and you keep stacking move upon move upon move, you're stacking 230% with an extra 40% and an extra 50% and an extra 50%, and then you're 8 timesing your initial investment. You can see how a sufficiently sophisticated swing trading strategy can very, very quickly make you exceptionally rich. So what you just saw was a historical example of what the method is intending on doing. However, it is designed with hindsight, so knowledge of the past. If the price we intend on trading is almost random, then it will take significant analysis to determine the expected future outcome, which is the probabilities of the future moves. This becomes even harder when other market participants are attempting to do the same thing. Competition, and therefore difficulty in forecasting, is closer to the present. For example, it is known that Bitcoin will go up in 4-year cycles, for sure. We'll be exploring that in the stock to flow model, but it's uncertain the path it will take to get there over the course of weeks and months. So, into the realm of swing trading analysis, how do we derive the future and how do we get the probabilities on our side so we know what we're doing? First analysis method I want to look at is systemization. This is the highest form of analysis, and it's a little bit conceptual, so just bear with me here at the moment. This is where you have a manual, semi-automated, or fully automated process which incorporates multiple forms of analysis into a single system. Each form of analysis within the system would preferably have data going back to the inception of the asset you're looking to trade. This is for extra testing reliability. It also has the added benefit of removing almost 100% of the human element from the process, lowering the probability that emotional flaws and cognitive biases will corrupt the outcome. We will be looking to design this system for you by the end of the course, along the lines of the one that I've made for myself, because this is the method that I use. Analysis method, fundamental economics. All prices are determined by open market forces of supply and demand within an economy. Assuming we know the given supply and demand of an asset, we can approximately derive its price. Furthermore, if one holds demand constant and future expected change in supply, a future expected change in supply can allow future prices to be estimated. This is the foundation of the stock to flow model for Bitcoin price forecasting. We will be exploring this in the future units so that we can exploit its signaling capacity. Analysis method, on-chain data. Data on the movement of coins within the cryptocurrency network can reveal insights on investor behavior and help answer questions that can't be solved any other way. Is the trading environment becoming more or less liquid? Are investors suffering losses? From which time periods are they suffering losses? Are older, smarter investors buying? Are they selling? Are they accumulating? Are investors preparing to buy in large sizes? Are they preparing to sell in large sizes? Often subject to spoofing, and sometimes the activity takes time to show up in the price. Many of the data points are lagging, meaning they show in the past only. I'm a huge fan of on-chain data. It can reveal a whole lot of really bizarre and really interesting insights that you wouldn't be able to find anywhere else. They can be exceptionally useful. Need to be used in context with other analysis methods, though. The next analysis method is the macroeconomic regime. This is the highest level view of an economy seen through the lens of growth and inflation. There are four macroeconomic regimes, each with their own broad effects on asset prices. Cryptocurrencies are considered risky assets and rise generally in all macroeconomic environments except for deflation, with the highest price rises seen in Goldilocks. This is a blown up view of the one we had just on the last slide. This is current at the time of recording. What's the date today? The 3rd of August, 2021. So what you can see here is that going into June and July, we had a rapid change into forecasted deflation. August, September, a little bit of deflation there too for the next 2 months. So from a macroeconomic regime perspective, you could say that we're actually in quite a risky phase right now, which puts the rally that we've seen at the beginning of August on a little bit of rocky footing. Now, always remember that all these analysis methods have to be taken together. However, what this can do is it can set up the frame for the rest of the analysis, where we're kind of looking at the backdrop and going, well, if we have something that's like the tide, this is like the tide. It's powerful. It's behind the scenes. It doesn't. It goes very slowly. It doesn't immediately affect assets, but there is a risk there. There is a risk there that something bad may happen, but we just need to confirm or deny that with other analysis to be exactly sure. And if that was to drift upwards over the course of the next month, and then September drifts upwards into Goldilocks, September, November, potentially you could say, well, maybe something very good might happen. It's up to analysis. There's a lot of different ways to read that, but generally it's just good to keep that in mind. Now, the next analysis method, sentiment data. Sentiment data shows the level of fear and greed investors are feeling from each point in time and can be derived from surveys, but not always. Typically, sophisticated investors, such as large hedge funds, will attempt to counter-trade uninformed investors, so retail traders like us, to buy when there is maximum fear and sell when there is maximum greed. Our job is to use this data to our advantage instead of becoming prey to our emotions. If you don't know what I mean by that, please go back and review my lectures on investor psychology, where we look at the full market cycle and how fear and greed works with those. You'll find those in the cryptocurrency strategy channel. Sentiment data can be subject to extreme variability and inaccuracies. Often the sample of investors are biased. However, it can be useful as a secondary piece of analysis. You see, one of my favorites up here at the top is the Centex sentiment gauge for Bitcoin. You can see it's almost entering a position of overboughtness, but it was coming out of a very oversold place. So clearly it was signaling that it was an opportune time to buy. You can see opportune time to sell. You can see it's very noisy, a lot of the time it's not useful, but when it is at extremes, it can be useful when combined with other analysis. The fear and greed index is another classic one. You can see here that in the latest dip, the latest crash, it was basically grinding along the bottom between 10 and 20 almost the entire time. Fantastic signaling power to basically tell us that we needed to purchase more before the rally. Not always correct, but can be combined with other analysis. Another analysis method, the statistical significance. Recurring events can be checked for significant predictability regarding asset prices. This type of brute force analysis often arrives at bizarre and unexpected conclusions, such as the following samples taken on the same day. So, yeah, this type of stuff, I do enjoy this type of analysis. I do love statistics. However, you can see the bizarreness of having different different analyses taken on the same day and having the numbers crunched. Bitcoin after the synthetic VIX crosses, blah 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 blah. You can see that over the course of Bitcoin's history, this whatever this type of signal was, whatever it could be anything, as long as it's a reoccurring historical event. Whatever it is, for some reason, whatever it is when it happens, it leads to persistent bad returns over the course of 1 to 3 months. You can see here it is significant using the Z-score, which is a statistical measure of how significant the reading is. So anything above a 2 is very significant. 2, 3.6, 3.9. So very highly likely to lose money over the next 1 to 3 months using this particular signal. But using this particular signal, whatever it is, could be anything, we can see here that we have significant gains over all time frames again. As a matter of fact, between months 1 to 3, we have significance up in the 4s. Very, very powerful signal, but also very powerful over here as well. You can see here that conflicting information using this type of stuff is an absolute nightmare. And when you have a lot of one type and not the other, you can read into it. But in general, very, very crazy stuff. And you want a big sample size. If I was looking at these two on the same day, I'd be more inclined to look at this one, even though we have a few overlaps, because a lot of overlaps actually. It's biasing the results, but yeah, the one with the higher sample size is usually the one you want to go for, because it will have more significance. But as you can see, the randomness can sneak in here and make this type of analysis not super viable if you have some conflicting data. Which leads us to our last one. Last analysis and method is technical analysis. So this is a field of price pattern research that suggests future prices can be probabilistically predicted from past prices. This can be broken down into two categories, in my personal opinion: discretionary and studies. Discretionary is where an individual draws patterns on a chart using lines, boxes, and wedges, etc., in an attempt to predict the future. You can see here, this is a classic example of head and shoulders patterns is typical. Having different types of wedges or different reversal patterns, such and such. Studies are mathematically derived systems that use price data to either denoise the price to reveal trends or to rank the price relative to its historical behavior to reveal reversals. You can have a look down the bottom here. I'm not exactly sure if the resolution is good enough on the video that you'll be able to see here, but essentially this has a lot of ranking characteristics here. It's trying to tell you when the price is very cheap and very expensive, and all of this reoccurs over and over and over again. Yeah, so when it comes to technical analysis, this is essentially what I see in my mind. I hate technical analysis. I think it's trash. It's subject to confirmation bias. It's subject to data mining. It's essentially tea leaf reading, tarot card reading, astrology for men. This is astrology for men. Okay? The types, like, look at studies, for example. The calibration that you can do with study, they all have different parameters, but you can set up parameters any way you like. There's quite literally an infinite number of different calibrations that you can do to these different studies. So when it really comes down to it, it's a case of, well, what is the ultimate calibration? If you're taking a moving average and it's the 100-day moving average, it's like, well, what's the significance of a 100-day moving average? What's the significance of a 50-day moving average? Everybody uses 250-day moving averages, but it actually doesn't mean anything. It doesn't actually mean anything. There is no significance to 50 and 200. It's only because everybody else watches it. As a matter of fact, the only use for technical analysis is to try and figure out what it's trying to tell you so that you can do the opposite of it. Talk to Michael. You'll see anytime that you get a technical level that it seems like the type of level that everybody will draw a line against. Generally, people will believe that that's some sort of resistance, but because people place their stop losses below it, it actually adds forced selling into that particular area. So if you have the price and it just whispers below that area, typically it'll just look like a stop hunt, and you'll have a massive decline in the price, wipes everybody out, and it just continues. And you were like, oh, well, but the moving average is meant to hold the price. Bullshit. Doesn't fucking work. Take a good look at this top top one here, I'll give you a good example of how I feel about it. So pause the video and read this if you want to laugh. Quickly, it'll just, because people place their stop losses below it, it actually adds forced selling into that particular area. So if you have the price and it just whispers below that area, typically it'll just look like a stop hunt, and you'll have a massive decline in the price, wipes everybody out, and it just continues. And you were like, oh well, but the moving average is meant to hold the price. Bullshit. Doesn't fucking work. Take a good look at this top one here. I'll give you a good example of how I feel about it. So pause the video and read this if you want to laugh. So as far as I'm concerned, this is the all the different methods of analysis and their reliability. You can see technical analysis is right down there at the bottom. It's a timing tool, nothing else. After you've finished all the other different types of analysis first. If you're learning technical analysis and you're a beginner and you believe that it somehow holds the keys to the universe, somehow there's any signal involved in that, you are going to get killed. You're going to stay poor forever. Brutal, but true. What we're going to be doing is we're going to be looking at all these different types of analysis as we go through this course, and we're going to be essentially not going super deep into them. I'm just literally going to be giving you the materials for each of these. Generally, we're going to go through number 2 to 6 first, then number 7, and then we're going to systemize the whole lot so we can know exactly where everything sits. And yeah, so we can make the absolute best, most informed decisions possible, while at the same time removing human emotion. So remember, it's not just about getting rich, it's about getting rich for sure. You're going to be hearing a lot of that from me. So that being said, prepare for unit number 2, where we explore cryptocurrency asset selection. This was a very basic lecture. It was very simple. We're going to be getting a lot more advanced from here. I've tried to simplify everything as much as I can. I could have made this 100 slides long, but I only made it about 30 or something. Yeah, I'm not going to be treating you guys like kids or children. We're here to make money, and we're here to do it the right way. We're here to do it the way that works. We're here to do it professionally. So I hope you're prepared. I hope you've got your thinking caps on, because as I make the following lectures, I'm not going to be treating you like idiots. I'm going to be treating you like professionals, and we're going to be learning the concepts. I'm not going to make it overly difficult for you. I'm not going to intentionally make it difficult for you, but I'm not going to dumb it down either, as much as I can to get the message across. That being said, please go over the lecture again if you'd like. If you have any questions, jump into the crypto general chat or crypto questions chat, and hit me with an @ tag, so we can clarify anything that you have questions on. I'm here for you. I'm here to tutor. Send me messages, ask me questions, please. Yeah, I'm going to get killed